Hey everyone, it's Mikey Millions here, and I have something important to share. But YouTube didn't like the first cut of this video because I apparently wasn't thinking of the children. So let's take a second pass at this important information, but with a PG filter. Let's talk about investing in pharmaceutical agricultural products. I participated in the DARE program in my idealized 1990s New Jersey childhood, and since then, I have never let Darren the Lion down. I've avoided trash of all colors, prices, and smells, and stuck strictly to sucking down as much iced tea as I could fit in my liver, like a proper college student. Despite all this mental fortitude to say no to crime, I will absolutely not say no to great stocks. Organic medicine in the United States is still largely concentrated in the hands of street pharmacists and young entrepreneurial co-ops. However, the Democratic Congress and White House have been dropping hints that this might finally be the year in which techno becomes nationally legal for recreational use. And further, states have been legalizing techno in every election since the early 2000s. During the next year or two, we may at long last see regulated businesses take their share of the medicine market and have experienced breakfast connoisseurs released from prison and put to work developing this new and thrilling industry. This excites me not only from a morality standpoint, as I believe legalization is long overdue, but just as importantly, from an investing standpoint. If medicine does get the green light, we will find ourselves fortunate in that we will be among the first people to invest in America's green rush, without risking jail time. Although pharmaceuticals have had their fair share of disappointments in the past, I think we're finally ready to hear that L word. Many of us want a piece of the pharmaceutical industry's profits. Let's talk about how we can invest in innovation in a way that brings us a high probability of serious returns. When people think of investing in agriculture, their first reaction is usually to buy up shares of the well-known companies: Aurora, Afria, Canopy, and Tilray, just to name a few. Historically, they've let us down, although lately they've been working out great. I even have calls on Afria myself. But let's face it, there are thousands of pharmaceuticals, and none of us have any idea which ones will emerge as the big, profitable industry leaders. Although we could see tons of small companies competing for market share into perpetuity, that's usually not the model we see in the US. Look at the beer industry. Anheuser-Busch, Constellation Brands, and Molson Coors control more than half the market between the three of them. Philip Morris, British American Tobacco, and Altria control the cigarette industry. Wynn, MGM, and Caesars control the casinos. I predict that the US farm industry will end up being similarly controlled by a few key players. And right now, we have no idea if Tilray or Kronos will be the better investment, or if both of them will fizzle out in favor of one stronger player. So if we want to invest in a way that protects us from picking up a bunch of losers and pretty much guarantees us the winners, how can we do that? If you're one of the OGs, you already know where I'm going with this. We can use an ETF, or exchange traded fund. ETFs are funds that purchase shares in many companies in a particular industry so that the investor can own a wide variety of companies with a single stock ticker. You just have to buy that one ETF. There are ETFs for just about every industry you can think of, even something as specific as Slim, an ETF that holds a bunch of companies that specifically service the medical needs of the obese. In the case of agriculture, there are a handful of good ETFs to choose from. They've all got fun names like POTX or THCX, but I've got 4 that I'd like to show you, and I think everyone interested in investing in farm could benefit from using at least one of these ETFs, as opposed to taking a pass at buying individual stocks. Okay, here we go in no particular order. The first one up is the first agricultural retailer, and probably the most well-known, the Alternative Harvest ETF, MJ. Mary Jane holds a lot of names that we are familiar with: Tilray, Aurora, Kronos, and the like, all of which are primarily Canadian. MJ is a good investment for people who believe that the more developed Canadian farm co-ops will form partnerships with US companies, or perhaps set up shop in the US themselves, and use their advantages as developed organizations to profit off the US market. Don't discount this as a long shot. There are a couple of advantages to investing with a Canadian focus. Like I just mentioned, these Canadian companies are already fairly well developed. They're growing more food than they can sell, and some are exporting their produce. These companies are craving access to the US market, and if legalization happens, they're already ready to shovel as much mota across the border as they can. A disadvantage of MJ is that it's just Canadian. The fund does not invest at all in companies with their primary business in the US. That means if US law is protective of domestic culinary art, MJ's holdings might end up missing out on the rush. None of these companies have much of a foothold in the US already, which means they'll need to form strategic partnerships with US companies. And that may very well happen. Altria, a US cigarette manufacturer, took a 45% stake in Kronos, and Tilray has demonstrated the ability to export by exporting to both Croatia and the US. For disclosure, I have one in-the-money call on Afria, one of MJ's largest holdings, although I don't own any MJ directly. I'm holding Afria because it's actually turning a profit, unlike many other of MJ's holdings, and because it appears poised to merge with Tilray to become the largest by production volume. After the merger, it will also produce organic soda in partnership with Anheuser-Busch. Doesn't sound very good to me, but someone is going to want to drink it. When it all boils down, if you expect that Canadian and American companies will work together to form North American agricultural partnerships, then MJ is a great choice. The next option is AdvisorShares Pure ETF, ticker YOLO. Don't get cute and YOLO your portfolio into YOLO, but this is a good play, and it is in fact my preferred choice. I'm using profits from other plays to buy shares of YOLO in my Robinhood 3K Challenge account, and right now I have 27 shares. I'd have more in my Big Boy account with Merrill Edge, but those shares are restricted by Merrill Lynch since it owns holdings that perform illegal activity under US law. Really. That's right, YOLO's holdings include both Canadian and American companies. About 68% of YOLO's holdings are concentrated in US companies, with the other 32% concentrated in Canada. This is a great ETF for people who believe the US club scene will develop largely on its own, but will integrate with Canadian companies where it's advantageous. This 1/3, 2/3 split puts a large emphasis on US companies like Grow Generation, Innovative Industrial Properties, which is a greenhouse REIT, and Curaleaf. The advantage of YOLO is that many of its US holdings are actually turning a profit already because they operate in states where use is already legal and can bring their CBD and greenhouse infrastructure products to the market. This will be exacerbated if and when recreational use becomes fully legal. YOLO shies away from Canadian companies that are focused specifically on produce and have struggling balance sheets like Aurora. Instead, its Canadian holdings include companies that won't be entirely dependent on pharmaceuticals for income, like Village Farms, a Canadian vegetable company that deals a little on the side. Having a nice revenue stream already makes these companies good long-term holds, and YOLO has an around 6% dividend, much of which comes from IIPR, a real estate investment trust that specializes in high-quality greenhouses. The biggest risk of YOLO is that its US-focused holdings may get boxed out if Canadian growers like Afria and Kronos end up taking a large stake in the US market. If imports are left to the free market, we're likely to see the Canadian players overshadow the fledgling US industry. YOLO has a couple of these Canadian holdings, like Afria, but it is not nearly as concentrated in large growers as it is distributors of final products. Depending on how consumer demand shapes up, YOLO holders could end up feeding off the scraps left behind by the larger growers headquartered in Canada. I personally think the US market will develop strong players of its own very quickly, and so I like the idea of a US-focused ETF with exposure to the Canadian market where it's advantageous, so I'm rolling with YOLO. Plus I like the ticker, and I like IIPR. I think that company is a gem. Those who feel even more passionately about America's ability to develop its own agriculture, independent of Canada, would be fans of our next ticker, Advisory Pure US ETF, MSOS, or MSOS. MSOS does exactly what its name implies. It invests specifically in US recreational companies. Green Thumb, Trulieve, and Curaleaf are its largest holdings, all of which distribute products to dispensaries around the US. Trulieve in particular is doing really well right now, with rapidly increasing revenue and earnings on very good profit margins. This model has proven itself profitable. The advantage of MSOS is that if US farm co-ops develop a strong footing based on its huge market, enthusiastic entrepreneurs, and some already vertically integrated business models, this ETF will outperform the others that are bogged down by Canadian companies with limited access to the US market. This is particularly important if you believe US laws will be protective in terms of imports. we may find that any legalization will be paired with stipulations that prevent massive imports of foreign goods, so that the US can develop its own industry instead of being dominated by Canadian growers. If that's not enough, don't doubt that the fledgling US companies can perform well on their own. TrueLeaf is just one example. MSOS has a bunch of other holdings that are all operating profitably with high margins and swiftly growing revenue, partnered with an archipelago of dispensaries, all concentrated solely in the US. However, there are disadvantages to MSOS too. Its 100% concentration in the US means that if Canadian companies do get access to the US market, MSOS holders may miss out on Aurora's massive profitability as it sends trains of product into the US. Perhaps even more importantly, these little US companies with great margins but limited operational production may very well easily get squeezed out by giant Canadians stomping their way south across the wall. I'm just not sure if Cresco Labs will be able to compete with a vertically integrated company like Aphria if left to duke it out. But then again, I've never even hit a blunt, so what do I know? For disclosure, I do not own any MSOS because I like YOLO better. And cruising into our last ETF, we've got the Cambria Fund ETF, ticker TOKE, TOKE. This is kind of a different way of approaching food stocks, but I think it can be a good choice. In the 3 ETFs above, we made a couple of big assumptions. First, we assumed food is getting legalized. Then, we assumed that either established Canadian food companies would immigrate to the US, or that US companies that are already focused on food would grow up big and strong. We did not consider the idea that large US companies that are not currently involved in hedonism would use their vast resources to pivot to the food industry when the time comes. With TOKE, about half of its holdings are postured toward that belief, that tobacco and alcohol companies will co-opt the green rush in order to profit. It also has some exposure to the larger companies like Aphria. We've got some advantages here. In TOKE, we've got the 3 big tobacco companies, Altria, Philip Morris, and British American Tobacco. TOKE investors make the assessment that all these 3 huge companies have to do is swap tobacco for bubbles, and they're fully equipped to bring product to market. They've already got the rollers. They've certainly got the distribution network to put innovative cigarettes in every gas station and grocery store in the US, and perhaps most importantly, they have the money to make whatever changes they need in order to achieve market dominance. What better organization to get food to retailers than a cigarette company? TOKE also carries Constellation brands, known for household beverages like Modelo and Corona. Constellation itself has shown an interest in the music industry by purchasing more than 38% of Canopy. And also importantly, if legalization gets shot down, TOKE won't tank as much as the other ETFs that are so dependent on legalization. Aurora will get ganked if the green rush fizzles out on news that Biden vetoed legalization because he believes in decriminalization instead. Philip Morris, on the other hand, might take a hit, but not nearly as much as agricultural producers. TOKE can therefore be seen as a defensive play as well. As for its disadvantages, TOKE's exposure to cigarette and beer companies might mean that it's just not quite dank enough. It just doesn't have enough hype. If you invite a girl to your apartment to smoke noobs, she'll be like, oh my god, yeah, I'm like such a gamer. My friends are always telling me, and my parents, like, they don't even know. And then she shows up at your house, and you offer her cigarettes and beer. And she'll be like, okay, this is kind of cool. It's not really what I was trying to do, though. Maybe I'll see you in class? You fucked up. You should have picked an ETF with some more music. And further, perhaps this assumption that Marlboro can just stuff additives in its rollers instead of tobacco and suddenly have innovative solutions, maybe that assumption is wrong. Maybe agricultural specialists will need particular licenses that gas stations just can't get, so Altria's wide cigarette distribution chain is moot. New products might just taste like garbage and get discontinued. If you're looking for a pure food play to take advantage of legalized trans fat, TOKE just might not scratch that itch, and you'll end up FOMOing into another ETF at higher prices. Alright, there's a lot to think about here, but I hope this video gave you guys some ideas. If you're looking to get in on the green rush, I'm sure you'll find an ETF that'll get you there. Good luck with your trades, and I'm looking forward to smoking up with you guys. See you next time.